So welcome back from the break. We would like to look at the valuation of non-controlling interests with the next slides. And okay, so the problem here is what or how do we do that? How are we determining the amount for non-controlling interests? So we know that when a parent does not acquire all of the shares of a subsidiary, then there will be some shares owned by external third parties, and they will be called minority or non-controlling interests, as we already know. And well, how would we allocate a value to those outside shareholders? And basically, there are two different methods to value those NCI. We already use the proportion of net assets method without talking about it, because that is something when you do not have a share value, a fair value from a market, then we would use in practice to come up with a fair value of the net assets that is related to the non-controlling shareholders. We did that already. So that is called the proportion of net assets method. But I think when there is a stock exchange on which those shares are purchased and sold, well, I think this fair value hierarchy. You should, when you look at fair values, first take a market price from an observable price that is somehow observable. So in that case, you would look at the stock exchange and take the the valuation from that. So here is an example. We took in the Jamaica Kingston example, we said that the value of NCI was given with a 60 million account, but how did we got to that? So here is the fair value method, and that says, well, we can take the fair value. We know that the total number of shares is 200 million. So 20% of that is what is it? 20? It's 40 million shares. So when we look at the market, where you maybe see that at the stock exchange, the current value is $1.50 for one share, then you can estimate the fair value of the non-controlling interests at that date. When you look into the paper or into the internet, then you can see that the fair value is 60 million. So if we don't have that information, well, then we would just look at the net assets of Kingston, which is 300 million, and we just took 20% of that. So we have a fair value of that non-controlling interest of 60 million. So, well, in theory, these two numbers must not be the same, and that this here is just a pure chance that these two values are the same. So you should not expect that when you do that calculation, if you have a stock exchange number and you can see the market value of one share, that should not be the same as the net assets multiplied with 20. The problem in practice is also that we know the book values of the company, but we would never set up as an investor, a shareholder of Kingston. We don't know the net assets of that company. We don't know the hidden reserves in inventory and in fixed assets. So we would never be able to set up the net assets at fair values. That is only what the investor has to do based on all the insight that the investor has in the values of the assets and liabilities. So the investor can make that up, but not a normal non-controlling shareholder. So these two numbers will not be the same, but they're roughly the same. Well, that's what a lot of potential shareholders do. They will calculate and try to figure out what the fair value of the shares are. And if they are far away from book value, they might buy the company, hoping that sooner or later the share will increase in value. So you see that in this example, fair value of assets equal the market share price. That is why the fair value of NCI is the same as in the NCI's proportion of net assets. But as we already know, these values may differ from each other. All right, so these are the two methods that we would use in our case studies and also in the exam. So I would like you to do the case study Libya. Here are the facts and circumstances. Please calculate the goodwill arising from measuring NCI at acquisition on a fair value basis. And then B, calculate the goodwill arising from measuring NCI at acquisition on a proportionate basis. So what you should do is calculate the goodwill from the investor's point of view using those two methods that there are, and then explain the impact of how NCI is measured on the determination of goodwill. So does that have any influence on the goodwill? So the facts are that Libya acquired 70% of the subsidiary Tripoli. Total shares of Tripoli are 100 million. Purchase price was 800 million, and the net assets of Tripoli were 600 million. So obviously they paid a premium for that one. Tripoli shares are quoted on the stock exchange at $9 each. Okay, so here are the forms. Please use the forms, and then I will send you again into breakout rooms, and please work on these. So I have resumed the recording. Welcome back from the breakout rooms. We just had a look at the case study Libya. You will see the facts and circumstances on page 132. I think what I saw was very good. So basically we used these two tables for the solution for A and B, calculation of goodwill. And I discussed that already with some of you. So let me explain again. Well, when we use the market information, then we have a stock exchange value. And that, of course, is here in the facts and circumstances is said that there is a stock exchange price of $9. So one share is valued at the market with the $9. And that obviously is a fair value because we have an observable market price for such shares. So we know that the NCI, which is 30% of the shares, the total number is 100 million. So 30% of 100 million times 9 is a fair value for the non-controlling interests at acquisition date of 270 million. So that includes any goodwill that they would earn when they would sell their shares. So in that case, we can say, well, we know the fair value for the 70%, which is the fair value of the parent's investment. They paid 800 million for that. So that's clearly above the market price. So let's have a look at where they have 70% of the 100 million. So they have 70 times 9, which is 630. So the market value based on the share price for the main shareholder, for Livia, would have been 630. But obviously they paid more. So they paid 800 for that bundle, for that packet. And so they paid 170,000 more than their normal fair market price. So we will take that one. We will take the 800 for that 70%. And for the remaining 30%, well, that is the NCI's share, we will take that 270 million we just have calculated. So for 100% of the shareholders, the fair value would be 1,070. So when we deduct the net assets at fair value at acquisition, that represents 100% of the net assets, that was 600. So the difference now is 470. And now we have to understand why this is called a full goodwill. A full goodwill. It's not called a goodwill, it's called full goodwill because it derives from the market value. And the market value includes both the parent shareholders and the NCI, the non-controlling. And therefore, we would say that the portion of that goodwill is, of course, related to the non-controlling interests because we took the market price to arrive at that goodwill. So we call this difference a full goodwill. And in the end, we will attribute 70% of that. So that would be 329 million to the parent. So that goes into the retained earnings of the parent. And to NCI, we would allocate the difference or the rest, the 30%, which is 141. So that will increase NCI because that part of the full goodwill will go to those non-controlling interests. So if we don't have that information, if we don't have a market value to work with, then we will have to go to the net assets as we did already in our previous case studies. So we looked at the net assets, and then we would just take the portion of net assets which are valued at fair value. So it's not, of course, including any premium, but it is looking at what would the NCIs get when this is the fair value of the net assets. What would they get as a minimum? So the proportion they have is 30% in this example. So the net assets times 30% equals 180 million. And if we don't have that market value information, we will consider this to be the fair value of the non-controlling interest at the acquisition date. So you see, we will then use only this information, the 180 million, and which is the fair value of the NCI at acquisition, and then add the purchase price of the parent company, which is 800 million. So we have 980 million as a fair value for the whole company, 70 plus 30%. So that's 100% of the shareholders. And we have to deduct 100% of the net assets, which is 600 million. So in the end, we have a positive difference of 380 million, and we will call that goodwill. So we will not use the adjective full to describe that goodwill, and that means the goodwill is calculated for the parent only. So that 380 will only be attributable to the parent, not to the NCI, because we don't have that number. We don't have a market value for these shares. We only took the net assets of the investee to come up with a fair value for that, but that does not include any premium that would be paid on the market, and therefore we would not consider this to include a portion of the goodwill for the NCI. Therefore, when we have that kind of a calculation, when we come up from the net assets, we will only calculate a goodwill. If we have market information, then we are able to calculate a full goodwill, and then we will, of course, attribute some of it to NCI. If we have a full goodwill, we will allocate the portion to NCI and the parent. If we only have goodwill, then we will attribute that 100% to the parent. All right. So questions? So no questions. Well, then I do have a question. What in IFRS, do you know that already? What would we take? Would we take the full goodwill, or would we take the goodwill for accounting? Can you put that in chat for me? Okay, 2 answers in chat. So can you repeat the question? Was one remark. Well, my question was what or which of the 2 methods would you use in IFRS? So obviously these are 2 methods that you could follow, but are those 2 methods allowed under IFRS? And Lam, Tien Tuan, you said 3. What do you mean by 3?
Oh, I may understand about your question. Yes.
You didn't understand the question. Okay, good. So there is one suggested solution. The proportion of net assets is allowed under IFRS. So we would only be able to account for a goodwill that is related to the parent, and we would not go for the full goodwill method. Is that, I think that is your answer. What do the others think? Both. Depend on, do we have the share price or not? Well, yes, of course. We can only go for the proportion of net assets method when we don't have a fair value. When we don't have a stock price, but in case we have a stock price, can we do, or what do we have to do? Do we have to follow the full goodwill method, or do we have to still follow the goodwill method and proportion of net asset method? And both, no, I think both methods are allowed. Yes, and that is right, Min. You told me that both methods are allowed, and that is the answer of the IFRS standard. Yes, you can do both methods. So even if you have that information of the market value, you could go for the goodwill method. Okay, so the proportion of net asset. So you can have both. In case you don't have that market share, of course, you have to follow the proportion of net asset method because you don't have that information. But even if you have that information, you could still go with the normal goodwill, so based on the proportion of net assets. Yes, okay. All right, so we have now explained the impact on goodwill. So when NCI is based on fair value, then the resulting goodwill is called full goodwill. It represents all the goodwill of the subsidiary and is attributable to both parent and non-controlling shareholders. As a result, when full goodwill is impaired, the loss, of course, will be shared by both parent and NCI in the same proportion they would share profits. And when you don't have a fair value, well, or in the case where you don't want to look at fair values of a stock exchange, then you can use the proportionate basis. So when NCI is measured on a proportion of net assets, the resulting goodwill is just called goodwill, not full goodwill. So it represents only the portion of the goodwill of the subsidiary that is related to the parent. For NCI, no such goodwill was calculated and therefore will not be allocated to NCI. As a consequence, when goodwill is impaired, the loss will only be charged against the parent's profits or would increase any loss. NCI does not have a share in the impaired loss because in the beginning we didn't allocate some of the goodwill to the NCI. I think that is also clear. If not, please ask in chat. All right, so we have, it's 4 o'clock now in Saigon. Here it's 11, so we have half an hour and I think we can go for another case study. That is the case study Mount. So here are the facts and circumstances. Last year, Mount Corporation acquired 60% of the share capital of Everest. Total shares of Everest are 200 million. At acquisition date, the purchase price for Everest was 900 million. The net assets of Everest were 800. So Everest shares were quoted on the stock exchange at $5 each. At year end, the retained earnings of Mount are 500 million. The net assets of Everest are 950 million. Goodwill has been impaired by 100 million. So what do you have to do? Well, on the basis of measuring NCI at acquisition at fair value and therefore full goodwill, calculate at the reporting date A, goodwill, AB, NCI, and AC, the group retained earnings. And of course, we would do the same with the other method on the basis of measuring NCI at acquisition on a proportionate basis. Therefore, goodwill is only attributable to the parent. Calculate at the reporting date BA goodwill, BB NC, and BC group retained earnings. You have a lot of forms for that one. So please go to the forms and use those in the breakout session to work on these. Yes, and there is a comment in chat, teacher, I wonder which method is more preferred in reality. Yes, no wonder. The goodwill method is preferred in reality from my perspective. I will look that up in a book for you, but that would be my gut feeling. And okay, so the problem is when you use the full goodwill method, that will inflate the balance sheet, and in case there is an impairment, of course, if you have a higher goodwill, that will written down with a higher amount compared to a situation where you have only a goodwill that is attributable to the parent. So I think in practice, you will more or less find the goodwill method, and only a few companies will use the full goodwill method. But that's a good question. I really thank you for that one. So now I will put you into breakout rooms, and I will use the same breakout rooms that I did before. So I will resume I will halt